Welcome to this deep dive, everyone.
Thanks for having me.
We are doing this talk ticker style today, which means we are going data forward, cutting through the Wall Street jargon and, getting right to the actionable stuff.
Right, plain language only.
Exactly. And our mission today is breaking down the Q3 2026 earnings call for KLA Corporation. Ticker is KLAC.
A really fascinating quarter for them.
Oh, absolutely. Because look, everyone right now is chasing the obvious AI chip makers, right? People are trying to guess which logo is going to be on the server racks.
NVIDIA, AMD, all the usual suspects.
Right, the designers. But what about the companies building the specialized tools to actually manufacture those chips?
The picks and shovels of the whole AI boom.
Yes. And KLA just dropped a massive quarter that basically proves that this underlying infrastructure play, the picks and shovels, might actually be the smartest move on the board for a retail investor.
I mean, if you read through this transcript, it's hard to argue with that.
Totally. So, for everyone listening, here is the setup for today. We are going to hit the headline numbers first.
Got to start with the data.
Right. Then we'll unpack the real story driving that growth, look at management's forward guidance, and finally, give you a bottom line, opinionated verdict on what this stock means for your portfolio.
Sounds like a solid plan.
So let's just jump right into section one, the headline numbers. And I want to start with the sheer financial gravity here.
Yeah, these are not normal hardware numbers.
No, not at all. So for the March 2026 quarter, KLA pulled in top-line revenue of $3.415 billion.
Which is up 4% sequentially.
Right, and up 11% year over year, which is just steady compounding growth.
And in the semiconductor equipment space, that industry is notoriously cyclical.
Boom and bust, usually.
Exactly. You get massive booms when new factories are built and then brutal busts.
Yeah.
So seeing double-digit year-over-year growth in this environment is huge.
It really is. But the profitability is where I think retail investors need to pay close attention. Their non-GAAP diluted earnings per share, or EPS, came in at a massive $9.40.
A huge beat.
Right. But their GAAP EPS was $9.12. So we have a 28-cent gap there.
Yeah, that always trips people up.
It does. So for the listeners, can you translate that Wall Street jargon? Why do analysts care about the non-GAAP number? And what is KLA stripping out to get to that 940?
Sure, yeah. So GAAP is generally accepted accounting principles. It's the SEC's strict rule book.
The required stuff.
Right. Under GAAP, you have to report every single expense, even if no cash actually left the bank account.
Like what, for example?
The biggest one is stock-based compensation. When KLA pays its engineers in stock, GAAP says, hey, you have to record that as an expense.
Even though they just issued shares, not cash.
Exactly. Non-GAAP is just management saying, look, if you strip out that accounting noise, here is the actual cash our core operations generated.
Which gives a much cleaner baseline for next year's projections.
Exactly. Wall Street loves non-GAAP for hardware businesses.
Makes sense. And digging into that 940 number, the CFO, Brent Higgins, says something really interesting.
About the tax rate.
Yeah. He said they beat internal expectations, but that 940 could have easily been 950 if their tax rate hadn't fluctuated.
Yeah, they guided for 14.5%, but it hit 15.4%.
Right, so a 90 basis point swing. And I want to pause here for the listener. A basis point is just 1/100th of 1%.
So 0.9%.
Exactly, which sounds microscopic, right? But on KLA's revenue, that tiny shift wiped out 10 cents of earnings per share.
It just highlights the insane scale they are operating at. A tiny foreign tax adjustment swings EPS by a dime.
It's wild.
Yeah.
But let's look past the tax stuff because the core margins are what blew my mind.
The gross margin is incredible.
62.2% gross margin, beating their own guidance by 45 basis points, and operating margin was 42.6%.
Yeah, those are software numbers.
Right. If I see a 62% margin, I assume it's a Silicon Valley sauce company selling cloud subscriptions.
Because software has zero marginal cost to replicate.
Exactly. But KLA is building literal multi-ton, hyper-complex physical machines, exotic optics, lasers, granite bases.
Heavy manufacturing.
Yeah. How does a heavy manufacturing company pull a 62% gross margin?
Well, you have to understand the existential terror of a low manufacturing yield.
Okay, unpack that for me.
KLA completely dominates what's called process control. They have like 7 times the market share of their nearest competitor.
Wow, 7 times. So they have a functional monopoly.
Basically, yeah.
Yeah.
And process control is all about metrology, measuring the microscopic features, and defect inspection.
So finding the flaws on the chips.
Right. So imagine a fab. They take a bare silicon wafer and put it through hundreds of steps, baking it, etching it, dropping chemicals on it.
Sounds expensive.
Very. One finished wafer full of advanced AI processors can be worth $1 million.
$1 million for one plate of silicon.
Yeah. So if a fab manager realizes a microscopic speck of dust ruined 5% of those chips on step 400.
They are bleeding millions of dollars.
Millions. So they freeze the assembly line and they bring in KLA's machines to find the defect.
I like to think of it this way, and tell me if this analogy works for you.
Go for it.
If a semiconductor fab is a really high-end restaurant kitchen, KLA is the ultra-strict health and quality inspector.
I like that.
Like they are making sure every single dish is flawless before it ever leaves the kitchen door.
And if they find a problem, they tell you exactly which stove caused it.
Right. So the fab will happily pay whatever KLA asks.
Exactly. If a KLA machine costs $50 million, but it bumps your yield up by 2%, it pays for itself in weeks.
So KLA knows this, and they price their machines based on that massive value they provide.
That is the secret to a 62% margin on hardware. Complete pricing power.
Unbelievable. And that leads directly to their cash flow, which is the last headline number I want to hit.
$622 million in free cash flow this quarter alone.
Yeah. That's a trailing 12-month free cash flow margin of 31%.
Massive.
And they are giving it right back to the shareholders. $875 million returned this quarter.
$626 million in share buybacks and $249 million in dividends.
Which is just a fortress of a balance sheet. They're reducing the share count, which makes your shares as a retail investor more valuable.
It's the ultimate sign of a mature, confident business. They generate more cash than they can even reinvest in R&D.
Okay, so the numbers are undeniably strong, but numbers looking backward only tell half the story.
We need to know what's driving it.
Exactly. Let's move to section 2. The story behind the numbers. What is actually fueling this massive revenue surge?
The loudest signal in the transcript was definitely advanced packaging.
Oh man, the packaging boom. Management totally revised their estimates on this, right?
Right. Massively. They originally thought their process control revenue tied to advanced packaging would be around $635 million in 2025.
And what's the new number?
They're now projecting it to hit roughly $1 billion in 2026.
$1 billion. That's what, 60% year-over-year growth?
Yeah, high 50% range, according to the CFO.
That is not a normal forecasting tweak. That's a structural shift. What is going on with packaging?
It all comes down to the death of Moore's Law.
Okay, so transistors can't get any smaller.
Right. For decades, we just shrank transistors to make chips faster. But now they are just a few atoms wide.
If you go smaller, physics stops working.
You get quantum tunneling, where electrons literally teleport through barriers and short-circuit the chip.
Right, so we hit a physical wall. So how do we make faster AI chips?
You stop trying to make one giant 2D chip. You make smaller chiplets, and you stack them on top of each other.
Like building skyscrapers because you ran out of flat land.
That's a perfect way to picture it, 3D packaging.
So they stack memory directly on top of the processor.
Yes, and they run microscopic copper pillars vertically through the silicon to connect them all.
But wait, historically, wasn't packaging just putting the finished chip into the little plastic square?
Yeah, it used to be the cheapest, dumbest part of the process. It was done on the back end, zero heavy inspection needed.
Because if you break it there, who cares? It's just the plastic lid.
Exactly. But now, with 3D stacking, you are fusing millions of microscopic copper pads on two finished, incredibly expensive chiplets.
Fusing them together.
Right. And if a single speck of dust gets in there, or one pillar is misaligned, the whole stack is dead.
And you just ruined months of front-end manufacturing.
The cost of a defect there is astronomical. So fabs suddenly need KLA's most paranoid atomic-level inspection tools at the very end of the assembly line.
Which accidentally created a brand new billion-dollar market for KLA?
Completely. They gained 14 percentage points of market share in wafer-level packaging in just 1 year.
That is incredible. But advanced packaging was only part of the story. The other thing I kept seeing in the Q&A was what I'm calling the yield squeeze.
The desperation from the fabs.
Yes, fabs are running at absolute maximum capacity because everyone needs AI silicon right now.
And you can't just build a new factory overnight.
Right. So chip makers are doing whatever they can to squeeze higher yields out of their existing lines.
There was a great analyst question about this, asking if demand was from new factories or existing ones.
And Rick Wallace, the CEO, basically said it's existing factories trying to optimize. They're even retrofitting old, mature nodes with brand new KLA tools.
Which normally makes no financial sense.
Explain that. Why wouldn't they do that normally?
Usually a fab saves its capital expenditure for its next generation factory. Why spend $50 million on a new laser for a 5-year-old assembly line?
Right, just build a new factory.
But the demand for AI chips is so high, and the premium is so massive, that it's more profitable to spend heavily on KLA today just to bump the yield of an old line by 3%.
Because they can't wait 3 years for a new kitchen to be built. They just hire stricter health inspectors for the old kitchen.
Exactly. And because AI chips are physically massive, the yield issue is even worse.
How does the size of the chip matter?
Well, a standard wafer is like a dinner plate, right?
Okay, a 300 millimeter silicon plate.
If you're making tiny chips for microwaves, you can fit 10,000 on a plate. One speck of dust ruins maybe 3 chips.
You lose pennies.
Right. But an AI processor is huge. You might only fit 50 of them on that same plate.
Oh, wow. So one speck of dust
Ruins one entire massive chip. That's 2% of your whole wafer gone in one strike.
The statistical risk is so much higher.
Yes. So they throw money at KLA to guarantee the raw material is absolutely flawless.
Okay, but let me push back here because I want to play devil's advocate for the retail investor.
Lay it on me.
If you read the macro tech news, some major hyperscalers like Microsoft, Google, they've signaled they might cool off slightly on their AI capex.
The digestion phase?
Right. They bought so many servers, now they need to actually set them up. Doesn't that mean the music is about to stop for KLA? If Google stops buying servers, TSMC stops making chips, and KLA stops selling tools.
It's really logical fear, and an analyst asked almost that exact question.
And what did management say?
They basically debunked it entirely. Rick Wallace said the backlog is so massive that hyperscaler capex fluctuations don't even matter right now.
Wait, really? It doesn't matter if Microsoft cuts spending.
Not for KLA right now, because demand is so far ahead of physical fab capacity. Fabs are aggressively booking KLA tools right now just to lock in their place in line.
In line for what?
For when their new greenfield factory shells are finally finished being built in 2027.
Okay, so greenfield, meaning a brand new factory built from scratch on an empty field.
Exactly. Those take years to build. Concrete, steel, clean rooms. And the fabs know when the building is done in 2027, they need KLA's tools ready to go immediately.
So they are ordering them today.
Yes. Wallace said the urgency to secure future delivery slots is higher than he's ever seen in his career.
That level of future visibility is rare. But before we hit guidance, we have to talk about the unsung hero of this company.
The services division.
Yes. Services hit $775 million this quarter, up 16% year over year.
Which puts them at over a $3 billion annual run rate just for services.
For a hardware company, why is their services revenue so massive?
It's the ultimate razor and blades model. KLA's machines are running 247 in extreme environments, bathed in UV light and chemicals.
So they break down.
Or they just drift out of microscopic calibration. And you can't just call a local repair guy to fix an atomic level laser.
Right. You need KLA engineers and KLA proprietary parts.
Exactly. So every tool comes with a lucrative service contract.
Yeah.
And as they sell more tools, the installed base grows and the recurring revenue just snowballs.
It's essentially an enterprise SaaS subscription bolted onto a hardware sale.
Management project services will grow at a 13 to 15% CAGR through 2030.
Which provides an absolute safety net for the company. Even if no one buys a new machine next year, they still have to pay to service the old ones.
That's how they fund those massive buybacks and dividends so consistently.
Okay, so that perfectly transitions us to Section 3. Management guidance. What are they saying about the rest of the year?
The numbers are accelerating. For the next quarter, June 2026, they're forecasting revenue of $3.575 billion.
Plus or minus 200 million.
Right. And EPS jumping to $9.87.
But the market outlook is what caught my eye. The WFE market wafer fab equipment.
Basically, the total addressable market for all chip-making gear.
Right. Management raised their view. They now expect the WFE market to exceed $140 billion in 2026.
Which is huge, considering Wall Street was initially modeling around $120 billion.
The pie is getting much bigger.
Yeah.
And they expect KLA to outpace the broader market, projecting their top-line revenue to grow in the high teens.
And their core process control business to grow over 20%.
So they aren't just riding the wave, they are taking market share. And they even said 2027 growth will be higher than 2026.
Which goes right back to those greenfield factories finishing construction.
Right. But, and here's where I need your help, it wasn't all perfect. I saw a margin headwind in the transcript.
The DRAM issue.
Yeah, management mentioned a 100 basis point drag on gross margins for the rest of 2026 because of elevated DRAM chip costs.
Which sounds weird at first. Why does a company that inspects chips care about memory chip prices?
Exactly. But it turns out to process petabytes of visual data instantly, KLA has to bolt a massive supercomputer to every machine.
And that supercomputer needs tons of DRAM short-term memory chips.
Right. So memory prices go up, KLA's costs go up. But here is my paradox.
Let's hear it.
If KLA has a functional monopoly and customers are absolutely desperate for their tools, why don't they just raise the price of the machine and pass that DRAM cost to the customer?
It's a great question. An analyst asked the exact same thing.
Why don't they price on scarcity?
Because of a philosophy they call value-based pricing. The CFO, Brent Higgins, was very clear about this.
What does that actually mean in practice?
It means KLA prices a tool based purely on the mathematical cost of ownership improvement it provides over the last model.
So they don't just look at how desperate the customer is and invent a higher number.
No, because if they act like mercenaries today and gauge the customer, what happens in 2 years when DRAM prices crash?
Oh, the fab manager comes back and demands a massive discount.
Exactly. It would destroy the predictability of KLA's revenue. By sticking to value-based pricing, they build multi-decade trust.
They are willingly eating a 100 basis point hit to protect their pricing power for the next 10 years.
It's incredible discipline. And despite that hit, they're still guiding for roughly 62% gross margins overall.
The sheer profitability is just staggering. All right, let's pull all this together into section 4, the bottom line.
Time for the verdict.
Based on everything we just discussed, the advanced packaging boom, the yield squeeze, the greenfield backlog, the services cash cow, is this a bullish or bearish signal?
Unambiguously bullish.
I am right there with you. For a retail investor, KLAC is a premium wide moat asset.
The definition of a wide moat: 7 times the market share of the nearest competitor.
You literally cannot cross that moat, and they are throwing off 31% free cash flow margins, actively buying back shares, raising dividends for 17 straight years.
The fundamentals are rock solid.
And the beauty of this stock is that it is an agnostic infrastructure play.
I love that phrasing, agnostic.
Yeah. If you want exposure to the AI supercycle, you don't have to guess if NVIDIA, AMD, or Intel wins the architecture race.
Or if the hyperscalers just design their own custom silicon.
Exactly. Whoever makes the chips, KLA gets paid to inspect them.
And actually, the more fragmented and complex the chip designs get, the more intense process control they need. Complexity is KLA's best friend.
Right. But to be totally objective here, is there a risk?
Well, the stock is definitely priced for perfection right now. The market knows how good they are.
So any slight macro shock could cause near-term volatility.
Sure, but the underlying fundamentals we just unpacked completely support the premium valuation.
So it's a massive buy and hold candidate for an AI portfolio.
Absolutely.
Okay, before we wrap up, I want to leave you, the listener, with one final kind of mind-bending thought from the end of the earnings call.
The X-ray debate.
Yes. So as these transistors get down to 2 nanometers, they're basically smaller than the wavelength of the light KLA uses to inspect them.
They're literally trying to spot a missing atom with optical light. It shouldn't be possible.
Right. So an analyst asked, hey, are we going to have to switch to X-ray metrology soon? Because X-rays have much shorter wavelengths.
And KLA does make X-ray tools, so they are covered either way.
But the CEO, Rick Wallace, basically threw cold water on using X-rays for high-volume manufacturing anytime soon.
Yeah, he was very blunt about the economics.
He said, X-rays are great for a lab if you want to study one single atom. But for scanning thousands of wafers an hour on a chaotic factory floor,
it's exponentially too slow and way too expensive.
And that answer blew my mind. because it flips the entire semiconductor narrative upside down.
How so?
For decades, everyone thought Moore's law would die because we couldn't figure out how to print a smaller transistor.
Right, the lithography would fail.
But what if that's not what stopped progress? What if we successfully build a 1-nanometer chip? But the X-ray technology required to simply find the defects on it is so slow and expensive that we literally cannot afford to manufacture it at scale.
Wow, so the cost of the health inspector is what actually kills Moore's law.
Exactly. The ultimate financial bottleneck might just be the cost of looking at the chip.
Which just proves why KLA commands so much power. The harder the defect is to see, the more valuable the company holding the magnifying glass becomes.
It's an incredible position to be in.
It really is.
Well, that wraps up our deep dive into KLA Corporation. Thank you so much for joining us as we unpacked the invisible mechanics of the AI boom.
It's been fun.
For everyone listening, remember to look past the obvious tickers, keep questioning the consensus, and stay curious. We will catch you on the next deep dive.